Hello, my friends. Brett Patterson coming at you from the financial capital of the West, the land bountiful. Joined by the gang today. We got Mike. We got the chairman, the big fella, and Spencer. Hello, Spencer.
The tall fella.
Great to be here.
Hey, you guys. I wore something special today.
Yes.
In honor of our men and women's hockey team, my USA hockey jersey. Look at the back of that. O'Callahan.
Hey, is that number 17? Is that 17?
Yeah.
Go back. Hey, that's my number. I like that. Good job, Redder.
17 in honor of Spencer Nelson. This is 1980 vintage jersey right here.
That's nice. Awesome. Still looks the same.
Where did you get, Brett? Yeah. Where did you get that? Where'd you get that jersey?
All right, great story. Glad you asked. Great, by the way, great Olympics. I mean, come on. The women's, the behind the back goal against Canada in OT. That was insane. Did you guys wake up for the men's?
I did.
6 a.m.
I woke up.
Spencer had other things going on. El Presidente had other things going on. 6 a.m. I wake up. The house is quiet. About 9 a.m. house is still quiet. I'm thinking, this doesn't look very good, guys. This doesn't feel good. Canada's kind of beating us up. And then we push it to OT. And in OT, Jack Hughes with the goal. How amazing was that?
That was amazing.
Awesome.
So don't forget that goalkeeper. That goalkeeper had
MVP.
The new Secretary of Defense, Connor Halabuck.
That was
my gosh, you guys.
Yep.
That was insane.
He won that. I mean, there's no doubt.
Totally won it. And here's the best thing. I'm watching this in my house, and right when Jack Hughes puts it through the net, I scream, yes! And my entire house then woke up.
Yeah.
They missed it. But I'll tell you what, first time in 46 years to the date, 250th anniversary of this great country. I like the flag behind you there, Brian. It looks good. Where did I get this jersey? Here, funny story, Brian. Tommy Boy, my second boy, we watched the greatest Disney movie ever made, Miracle. You guys have seen that.
Yeah.
Second place, Swiss Family Robinson. We don't need to get into that. First place, Miracle. We watch it. He says, I got to get a jersey. So that's where the jersey came from. I made my boys watch Rocky IV and Miracle over and over and over. Anyway, it's a great week. You know what's funny about this whole USA hockey match was there was one person that was drinking and getting drunk before the match, and then he's still drinking today. You guys want to know who that is? Mr. Market. The stock market is completely drunk right now. That's what we're going to talk about today. We're going to talk about volatility. You had the best company in the world come out with earnings this week, and I don't know how. I won't mention the name, but it was down. It's down about 10% since it reported. So I think Mr. Market is drunk, and Mr. Market, which is the stock market, and that creates opportunities that some people view that as risk. So let's talk about risk today. That is today's topic. If you have Connor Halabuck in the net, there's very little risk, but we do not anymore. So 3 kinds of risk that we want to talk about today. We want to talk about volatility. Is it risk or is it not? We want to talk about sequence of returns. If you're retired or getting ready to retire, you better listen to that. And then we want to talk about liquidity risk.
Okay.
So Brian, let's talk volatility. Define volatility for us, and is volatility risk?
Great question, Brett. Volatility is a measure of just the market going up and down, price movement, and the more price movement, the more volatility. we don't define risk in terms of market volatility. It's just market volatility and it's noise. Of course, if your time horizon is short, then market volatility can equal risk. But as long-term investors, we look at market volatility as more of an opportunity to take advantage of great prices.
So right now, if I look at percent off the high for the S&P and NASDAQ, NASDAQ's down about 4.5%. S&P is about 1.6, 1.7% off of its highs. So the volatility, and a lot of stocks have been hit harder than that. I mentioned the one that's down 10%. So you're saying defining volatility is the ups and downs of the market.
Yeah, we call it beta, or in academic circles they call it beta. And it's interesting, back in the 60s, some academic professors decided that they could measure market volatility through this beta, and that's how they defined risk, because they could measure it. But really, we define risk as the permanent loss of capital, and we look at market volatility as just sort of noise, especially as we look at long-term investments, and we look at that as an opportunity.
So the volatility of the market, I think Spencer and you, Brian, you've mentioned this several times on this podcast. In an average year, the market falls 14%. Like that's its normal.
Right.
That's volatility. That's the ups and downs of the market. So you mentioned risk is the permanent loss of capital. Mike, what does that mean? Risk is the permanent loss of capital. What does that even mean?
It means that you've locked in a loss, right? When you buy a stock, what are your reasons to hold on to it, right? The market is the number one wealth generating machine out there with its volatility that it has. Some people over time do well. Other people over time don't do very well. One of the traits of those that perform well is not selling and taking a loss of capital that does become permanent when you sell it on those drawdowns, when that volatility occurs. Those that tend to do better over time tend to be those that are willing to actually add to their investments on a market drawdown, like Brian said. And when they need to sell, it's going to be much later on for reasons of, retirement or life or whatever, or selling when the market is high, right? So that permanent loss of capital, it becomes locked in when these markets decline and you wind up taking those losses. I mean, that doesn't excuse the psychology, though, right? It's easy to talk about this, but when the market is down 14%, talking about the S&P, you feel like you're losing money. That's the bottom line. It's how you feel. Investors that typically don't do as well over time, they're the ones that act out of that emotional response, and they sell when that pain is high. This is one of the things that I really appreciate, and I've learned since joining you here at Iron Gate, is that look for different reasons other than pain as a reason to sell. Use reasons based on an evaluation of the business, right? Brian does a terrific job. Well, y'all do, identifying strength of business, right?
So you said something interesting there. The permanent loss of capital. If you buy a stock for $100, it goes down to 80. You get spooked. You want out. You sell. You lost $20.
There's your permanent loss.
That's the permanent loss of capital. Like that. That's it. What did I see Spencer? He wants to quote Charlie Munger without quoting Charlie Munger right now.
Just paraphrase him.
Paraphrase Charlie Munger. What if you do that, Spencer? What would Charlie say?
I won't quote it exactly because I don't know it exactly. So I'm going to pull a Brett. But if a stock goes down and you want to sell it because it's gone down, you should never have owned the stock in the first place.
Hey, that is a great quote. If he didn't say that, we're going to credit Spencer Nelson. That's exactly right. So here's the question that I would have for the chairman. I want to bring the chairman back into this. How, and then we'll loop everybody else in too. How does, we talk about volatility, the ups and downs in the market. That's really the price you pay for returns. If you don't want volatility, you're in a treasury, which is giving you 3.5%, 4%, right? Like if you're going to be in the market, you've got to expect volatility. Volatility is not risk. Risk is the permanent loss of capital. How does the Iron Gate process, the 4 criteria that we've talked about so many times, how does that, it doesn't get rid of risk. There's no such thing. There's still risk, but how does it reduce risk?
I mean, yeah, that's really the objective of our process, is to reduce risk, minimize risk to an acceptable level. And if you think about it, I'll just briefly just mention each one of those. Only invest in businesses or industries we understand. If you don't understand it, you shouldn't be in investing.
Okay, I'm going to time out. How many times have you guys talked to your buddy, or maybe you've done this? I've done it in the past. You buy a stock because it's going up, and somebody asks you, that's an interesting investment. What does the company do? And the response is, I have no idea. Have you guys ever heard that?
Oh, I heard it yesterday on a pretty prominent podcast.
You did?
He said, I have no idea what they do, but hey, it looks popular. It's been going up, and he actually bought it. And, you know, somewhat of a respected podcaster.
There's that famous clip on CNBC from a few years ago, and I'm trying to think. It's like the lunchtime guy, or was on the lunchtime show. Someone was pumping a stock, and he was talking about all these different things about it and why they should own it and all this kind of stuff. And he was like, well, what do they do? I'm not familiar with that company. What do they do? And the guy was like, I'm having a hard time hearing you. What? I mean, you could tell he had no idea what the company did. I think a lot of I would say jackwagons do that, to be honest with you. But
why is it important to know? I mean, you get
you're mitigating risk. If we go in line with what Brian said, and you're trying to mitigate risk, if you don't even know what they do, you haven't mitigated risk at all, right? I mean, if you understand the business, then all of a sudden the risk, and you decide to buy it, the risk associated with it is down a little bit, right? If you don't understand what the business is at all, you have no understanding of what the risk actually is.
And you know where it's exactly right. When you know where I see this creeping in to people's actions, right? Where they buy these companies or these products, they don't even know anything about it, is when FOMO kicks in. The fear of missing out. How does FOMO relate to buying a business you don't have a clue what they do? How are they correlated?
Well, it's completely why someone jumps into something because their neighbor talks about it, or I mean, in New York, the taxi driver talks about it, or whatever. I mean, that's the motivator behind not understanding something, right? I have no time. I can't wait to do it. I have to do it right now, or else I'm going to miss out on it. Versus, hey, let me go read up on this company. Let me understand what they do first. So I would say FOMO has a lot to do with, especially when people are just jumping into stuff because they're worried they're going to miss the ship. And the reality is, the wise Kevin Hawkins said, don't chase a stock, don't chase a bus, and don't chase a date, because another one's coming in 10 minutes.
Yeah. I mean,
there you go.
That's good. You think about it though, if you don't understand the business and the market goes down, it goes down to, like in your scenario, Brett, it goes down to from 100 to 80. What's your reaction? Oh, wow, the market must know something that I don't. So what do? I mean, of course, you're probably very inclined to sell it. That may or may not be the right decision, but because you don't know anything about it, you put yourself in a bad spot.
Yep. That's exactly right. And then they sell when the stock falls, and that's the permanent loss of capital that Mike was talking about, right? So, okay, so criteria 1, you got to understand the business or you don't get in it. Criteria 2, Brian.
Yeah, durable competitive advantage. I mean, we look for companies that have durability to cash flows, long-term competitive advantages. And I always like to, this is the Charlie Munger. You invert, right? And you think about, okay, what does it mean to invest in a company that doesn't have competitive advantage? It has no advantage. I mean, that's probably not
Yeah.
a great strategy, and probably a good strategy to lose money, right? If you invest in businesses that don't have competitive advantages. So that's number two.
So with that competitive advantage, we've seen that in the market this year as there's been an AI scare as it relates to software companies, right? And these software companies, Mike, they're down 20, 30, 40%. I mean, why? Are they getting hammered so hard?
Uncertainty about their competitive advantage going forward in a new environment is why.
That's it.
Right? And that could be a changing landscape, and that might be a reason to either not invest or to take a loss, right? But when you're doing the research and you're paying attention to the environment that the business is within, right? If nothing's changed, well, can I say the name of the company? That company you were talking about, some of their earnings numbers where they grew their sales 75% year over year.
Yeah.
Their profit margin is now at about 70% on the stuff that they're manufacturing. That's not a business that's got, weakness. And that doesn't mean it's not going to change in the future, right? But am I answering your question right now?
Yeah.
Or am I just going off?
Well, you're talking about a company with a clear competitive advantage, but really, if a company does not have a clear competitive advantage and a moat, as Buffett talked about it, around the castle or around the company, then the risk of that company losing its edge or being sold off dramatically, I mean, however you want to say it, it's higher than a company that has a clear competitive advantage. So it's just about mitigating risk. Brian.
Yeah, you think about software stocks right now. The big debate is, I mean, really the whole debate on software stocks is the durability of those cash flows going forward. And now there's some question to that. And that's why the valuations are coming down, because there's perceived less durability potentially. We don't know for sure, but there's perceived less durability to those earnings, to those cash flows. And that's why the market's debating the value of software stocks right now.
Yep. That's why they're down 30 to 40%.
Right.
All right. So that's criteria two. Criteria three would be what? Is
management. So we look at management. Do they have a track record of creating value for shareholders? Number one. Are they honest? Are they hardworking? Do they work for shareholders? So that's more subjective, but we try to analyze the management team as best as possible. And really, for the most part, it's looking at their track record. Do they have a track record of creating value for shareholders? I mean, you think about it, would you hire this guy to run your own business? I think about it in those terms.
So, Spencer, why is
I'll chime in.
No one even knows who these CEOs are. Why is it even important?
So, because it's all going to hit the fan. This is why I think it matters who's running the company, because it's all going to hit the fan at some point. And whether it's going to be inflation or it's going to be COVID or it's going to be a recession or whatever it is. And whoever's running that company has to be able to pivot and navigate through the uncertainty. And you go back, I love a letter to shareholders by Warren Buffett in an annual report back in the early 80s. And after coming through the inflation of the 70s, and then some of it was in the 80s. And in it, Buffett talks about the two traits of businesses that really were able to continue to succeed during that time. And he said pricing power was one, and then great managers. Great managers are essential because the path from here, next 2 years, no one knows what's coming. And every single business has a plan. Every single business has a plan. It's like, hey, this is how it's going to play out. But what's going to happen is policies, legislation's going to change, regulations are going to change. There's going to be a tweet that changes tariffs. All of the uncertainty.
Technology is going to change.
Technology is going to change all of it. So it's not going to go as any one of them plan it to be. And who has the leadership to be able to recognize where that company needs to be positioned to not get left in the dust. And so great managers are so good. I actually think back to the venture capital world, and I remember hearing this, and I think it's true in many cases. The product or the service kind of matters, but especially in VC, you're investing in the team, because that team may start out with a product, and when they actually IPO, it could be a completely different business, but that team of leadership is able to navigate. So I think management is an enormous way to mitigate risk if you have great managers of a business.
So I remember sitting in an office of a very savvy client that we have, Spencer. I won't name names, but this is one of the smartest guys we know. And we're sitting at his table in his office, and we're talking about different investments that he could make. And he says, what do you think about private equity, a private equity fund? And my response to him was, hey, that's great. Who's running the private equity fund, number one? What companies do you know the management teams of the companies that your money's going into, right? And it was, is there more risk in a private equity situation for companies that are up and coming, or is there more risk investing next to Tim Cook of Apple, who who has a good track record, the products, everything else? And he stared at us for a minute. He said, okay, enough said. Here's the money, right? To invest. It's like, think about that for a second. There's all these sexy products out there. What's behind them? What's the management team? A track record is so important and so overlooked. For many reasons.
Can I? This reminds me of a Mike Tyson quote, and you might have to help me, correct me on this, but isn't it? Everybody has a plan until they get punched in the nose.
That's it. That's it.
And managers. I mean, there's no doubt every business manager gets punched in the nose from time to time, and you got to have a plan, and they got to be able to react under stress. Because businesses, things don't always go the way you expect. In fact, very, very seldom do they go the way you expect.
Yep, a good management team is so important. We've seen it in almost all the names that we own for clients. The importance of management, pivoting, making important decisions as things change, as Spencer said. So that's the third criteria. The fourth criteria, I think, is the hardest for me, because you have to be patient. What do I mean by that, Brian? What's the fourth?
Yeah, the fourth one is we understand the value of the business and what is the intrinsic value of the business. And so we go through and look at financial statements, look at revenue growth, we look at returns on capital, all kinds of metrics to analyze the business, and then try to come up with a fair price for that business. And then our goal is to reduce risk, and we do that by buying at a discount to that intrinsic value. So in your example, $100 stock, we determine it's worth $100 a share, and we want to buy it at 80 cents on the dollar, so a 20% discount or more to its intrinsic value. That's just another tool that we use to reduce risk. So for our folks out there that are just getting into the stock market, and we talk intrinsic value and all that kind of stuff, it can be confusing. Spencer, will you do this for me? Will you relate this? I feel like everybody understands real estate because most people own a home or a condo or something, or they want to buy one. Relate what Brian just said to the real estate world so that everyone understands exactly what we're saying.
If townhomes in Logan, Utah are selling for $300,000, we want to buy it for $240,000.
And what would the appraisal value of those homes be?
$300,000. So
Okay.
if townhome A went for 300,000 and townhome B went for 300,000 and townhome C went for 300,000 and we see townhome D and it's for sale, we'll go to them and we'll say we'll buy it for 240. And
There
if
you
they
go.
say no, then we'll say okay, we'll wait.
Walk away.
In
Wait.
the sense, if you're buying it for $300,000, you're paying full market value. And I've said it to people before, you can have a great business, and if you overpay for it, it can be a very poor investment. Vice versa, you can have a good business, but if you buy it right and you buy it at a big enough discount, then it can be a phenomenal investment. And so for us, you have to buy it right. We'll go Charlie Munger, and this is an actual quote, right? Big money is not in buying and selling, but big money is in waiting. And so waiting to buy or waiting when you own it, but it's in waiting. And most people have a really, really hard time sitting on their hands when stuff's happening. They want to do something, whether it be FOMO or whether it be the stock market's going down and I got to sell, whatever it is. But so I kind of elaborated, but it's just don't pay full market price. If you're going to Nordstrom's, don't ever buy something at full market price. Wait for the anniversary sale and get it at 30% off. If you're
There
going
you go.
to
I love it.
whatever store it is, we just won't pay full market price for a stock.
Yep. And the cheaper you buy an asset, the less risk is in it. You have that moat, that margin of safety, right? So, hey, tell me this, Mike. You're the newest kind of portfolio manager at Iron Gate Global. You didn't necessarily have those 4 criteria as you came to Iron Gate, but tell me, as you've been here managing money and helping us through the process of analyzing stocks, how important are those 4 criteria?
Very. I mean, it's the process. Follow the process. That means that's your product, right?
Yeah.
So it's everything. And it strikes me, as you guys were just speaking here, that the number one thing that's probably panicking most listeners out there is the volatility of the market. But based on being patient and identifying, an appropriate value and then buying things at a discount, that's the beauty of stocks. The volatility that they present, which tends to cause all the fear, it's what allows investors, value investors like that, people who are following the Iron Gate philosophy, right? That's what gives you the opportunity to buy in. So
I'm glad you mentioned that. That volatility presents the opportunity to buy at a 20% at least discount. Whereas in real estate, you don't often find that because you usually have 2 level-headed people and it's not a really liquid market, right? So it's a little harder to find those deals. In the stock market, we see some today. We've been buying. I was buying things today for clients. So that's a great point, Mike.
It answers the liquidity risk question too, for the most part, right? Good luck with a transaction in real estate. What's the slippage there? What's the slippage in stocks when you've got a good custodian that you're working with? It's very minimal. So in a lot of ways, the pain of the market actually becomes a really nice solution.
So let's talk about that liquidity risk. That's the second risk that we'll talk about today, and we won't spend a ton of time on it. But you mentioned something very important: being able to take advantage of opportunities when they come. Spencer, liquidity risk. What is that? It is the most often underappreciated thing, I think, in clients' assets. What is it?
Can you sell it when you want to get out of it? Can you turn it into actual cash and capital? And I say this to clients all the time. Most crises don't occur because people own bad assets. Most crises occurs because of liquidity. They don't have access to capital when they need it, whether it be a country, whether it be a business, whether it be a household and an individual. And then they get into a situation where they don't have liquidity, meaning cash to pay their bills or whatever it is. And then they're forced to either take on debt, or if they've exhausted that option, they have to sell assets out of desperation, which is usually a good time to be buying it from someone, buying that asset because you get a discount. So you look at real estate, what is liquidity? Depending on the real estate itself, very few transactions occur in a day in real estate. Most take 30 days, 60 days, 90 days, that type of thing. Some take 180 days, to be able to do transactions in real estate. Private equity, liquidity risk. Generally, most private equity funds are 8 to 10 year holds. And so if you're wanting to get out of them, usually you have to take a haircut to be able to get your money back. So asset classes that do have daily liquidity, minute liquidity, like the public markets, I think there is a premium there, right? In the sense of being able to get access to your money. And if you have that access, these other asset classes that don't have that liquidity, you should be paid a premium on that. So to compensate for the lack of liquidity. So public equities, because it's priced daily, there's absolute liquidity. In most stocks, there might be some, there's some bonds. You experience that sometimes when someone brings over this random bond that they, that they had purchased a long time ago, and you're like, I'm putting this out to market. I can't get anyone to buy it, right? Schwab is. So that's what you don't want to own. And so liquidity is the ability to turn an asset into cash. And fortunately, publicly traded equities, especially large cap publicly traded equities that we're talking about, they are very liquid and they can be turned into cash Monday through Friday from 7:30 p.m. Mountain Standard Time to 2 p.m. Mountain Standard Time in less than a second.
Yep. I love it. Liquidity risk for your cash needs, certainly. Here's the other side to that as well. If you have an asset that's up 20% and you see that's asset A, and asset B's fallen 30, 40, 50%, you can then, because of the liquidity, I'm going to take a little bit out of asset A to buy asset B, which is it's the Nordstrom sell on roids, right? Like we do that all the time. Sell this expensive asset to buy the cheaper asset because your growth long-term could be more with that
rebalance
asset.
Yeah, rebalance.
That's a rebalance. Yep. We do that every day for clients. So yeah, liquidity is so important. Okay. Last risk. This is especially for retirees. Our retired folks or those that are looking to retire, there is an often overlooked risk that's called sequence of returns risk. I'm not a financial planner. I don't claim to be. I'm a portfolio manager, but I'm glad we have a financial planner here. He's tall. He's the El Presidente. Sequence of returns risk. It kind of goes into liquidity too, Spencer. What do we mean by retirees and cash needs?
Oh, you're talking to me. I thought you were talking to Brian.
No, you're the El Presidente.
Oh, I'm the planner. I'm the planner.
Yeah, you're the planner. Yeah, Brian and I are not, Mike.
So when a person is withdrawing money in retirement and they've got their IRA or their 401k and they are withdrawing on that, and every month, let's just use an example, they got a $2 million 401k and they're withdrawing $10,000 a month, and every month they liquidate $10,000 and it withdraw it from the account. There are bear markets, right? And sometimes there can be an extended periods of time where the market is down. And when you are selling during times when the market is down to take your withdrawal out, not only are you selling at a low point, but you're also not giving that money time to rebound and compound on top of itself. And so the sequence of returns risk is we talk about compounding interest and how it kind of exponentially grows over time. Anytime sequence of returns risk is when you're selling, you're missing out on the opportunity cost is not only the loss when you're selling it when it's down, but also the lack of the compounding that's going to go forward.
Yep. Love it. That's forced liquidation, right? When the market potentially is down. Tell me, how do we with clients avoid, again, retirees, future retirees, how do we avoid that sequence of returns risk?
When a person gets into a withdrawal strategy, if they're within a year of retirement, 2 years is when we start talking about it. And then with a year of retirement, we start raising capital when the market is doing well. Like right now, right? I mean, we've 23, 24, 25, great years in the market. If a person is retiring, it's a great opportunity to raise capital if they were going to be retiring in 2027. And we have our 2-year cash management strategy, and that's based on the data that the average bear market lasts 16 months, and the average bull market lasts 5+ years. Brett could give me the exact number if he wanted to. And so what we do is we raise that 2 years worth of cash. And as the market is climbing higher and higher, we just rebalance it, right? So they get their 10,000 a month and we keep rebalancing it. And then we have a 22 type experience where the market goes down 18% over a 14-month period. All of a sudden, while the market's declining, we don't have to sell anything in order for you to get your withdrawals. And so, if it's average, we got 24 months. If it's average and it's 16 months, we've sent you 16 months and we haven't sold anything to replenish that cash. And then as the market recovers and starts to climb up again, then we start to replenish the cash and get back to 2 years. And that protects people from ever having to sell when the market is down, and that sequence of returns risk. So you're not only losing, like I said, when the market's down, but you're also going to be able to capture the compounding interest or the compounding growth when the market does rebound.
Love it. That's it. It's simple. If you fail to plan, you plan to fail. And that's why Spencer and his team are here, to build that plan, figure out those cash needs, to avoid risk. How often do we talk about risk at Iron Gate? I mean, every day.
Rule number 1 in investing: don't lose money.
Yep.
Right? That's it. And so that's risk. That is rule number 1. Is just don't lose money. So you have to have a plan to mitigate the risk. There's always going to be some risk. A meteor could hit the earth. All these great businesses that we own could just be demolished, type of thing. I don't know if Mike has a risk mitigator for a meteor, but the way we can mitigate risk is understand the businesses, make sure they have competitive advantages, make sure we trust who's running them, and then buying them at a good price. And then, like Charlie Munger, wait.
What's rule number 2?
Rule number 1 is don't lose money. Rule number 2 is remember rule number 1.
Exactly. Don't forget rule number 1.
So your risk mitigation on a meteor is Bruce Willis in Ben
Armageddon.
Affleck
Yeah.
going up.
Armageddon.
Is that what it was? Armageddon?
Yeah, it was Armageddon. Yeah.
That's it. I hope understanding risk, and most importantly for our clients, I hope that you understand that we at Iron Gate take risk very, very seriously. That's why we have the disciplined process that we do. Risk, key. Can't lose money. Rule number 1. Here's what I would also say. Here in the next week or two, we got the WBC happening. Do you guys know that?
I don't know what the WBC is.
Gosh,
Sorry.
Boxing?
you have the best. What is it, Mike? Don't
WBC?
Google it. You
That's
guys,
like the world boxing champion? Oh,
no, bro. You got the best baseball player in the world, Aaron Judge, playing for Team USA.
what happened to Derek Jeter? Isn't he around?
He's retired.
Oh,
You've
sorry.
got the second best baseball player in the world.
How's George
Shohei
Brett doing? How's George Brett?
Ohtani, playing
He
for
knows.
Japan. It's USA coming up. It's
Will
more-
Clark?
Huh?
If you got John Smoltz and Greg Maddux and Will Clark and
Sandy Koufax.
who else? Ron Gant. I would Oral Hershiser. If you got me Kirk
Yeah.
Gibson, all of these, I'd be in there. But I'm with Google. When I Googled WBC, what is it? It says white blood cells.
No. In the next week, there's more USA gear to wear. We're in the 250th anniversary of our country. We're managing risk appropriately, and we get to see Judge and Bryce Harper lace up the red, white, and blue, my friends.
Where is that played?
It's all over the country. I don't know.
It's in America?
And in Asia and in other areas of the globe. Yes, all over the place.
Is there a chance any games are being played at Alameda Park, where I played Little League in Pocatello?
Probably a very low probability, but you've got the commies of Cuba in this thing. I mean, this is going to be great. It's the WBC. Anyway, my friends, patriotism never stops.
Hold on. You can't say that without do the Seinfeld Steinbrenner impression when George said he was a communist and said,
"That's Larry David.
We got to send you down to Cuba. There's a left-hander, George. I love that you're a communist, and I'm going to send you down there. There's a lefty that we haven't been able to get to, and I want you to get him."
Yep. Anyway, get your TVs ready for more US of A, my friends. Hope you enjoyed the podcast today. Thanks, the three of you, for joining. Until next time, bye now.